Welcome to Thoughts on the Market. I'm James Lord, Morgan Stanley's Head of Foreign Exchange and Emerging Market Strategy. Today, the implications of tariffs for volatility on foreign exchange markets. It's Thursday, February 13th at 3 p.m. in London. Foreign exchange markets are following President Trump's tariff proposals with bated breath. A little over a week ago, investors faced significant uncertainty over proposed tariffs on Mexico, Canada, and China. In the end, the US reached a deal with Canada and Mexico, but a 10% tariff on Chinese imports went into effect. Currencies experienced heightened volatility during the negotiations, but the net impact at the end of the negotiations was small. Announced tariffs on steel and aluminium have had a muted impact too, but the prospect of reciprocal tariffs are keeping investors on edge. We believe there are three key lessons investors can take away from this recent period of tariff tension. First of all, we need to distinguish between two different types of tariffs. The first type is proposed with the intention to negotiate, to reach a deal with affected countries on key issues. The second type of tariff serves a broader purpose. Imposing them might reduce the US trade deficit or protect key domestic industries. There may also be examples where these two distinct approaches to tariffs meld, such as the reciprocal tariffs that President Trump has also discussed. The market impacts of these different tariffs vary significantly. In cases where the ultimate objective is to make a deal on a separate issue, any currency volatility experienced during the tariff negotiations will very likely reverse if a deal is made. However, if the tariffs are part of a broader economic strategy, then investors should consider more seriously whether currency impacts are going to be more long-lasting. For instance, we believe that tariffs on imports from China should be considered in this context. As a result, we do see sustained dollar-renminbi upside, with that currency pair likely to hit 7.6 in the second half of 2025. A second key issue for investors is going to be the timing of tariffs. April 1st is very likely going to be a key date for foreign exchange markets, as more details around the America First trade policy are likely revealed. We could see the US dollar strengthen in the days leading up to this date, and investors are likely to consider where subsequently there will be a more significant push to enact tariffs. A final question for investors to ponder is going to be whether foreign exchange volatility will move to a structurally higher level or simply rise episodically. Many investors currently assume that FX volatility will be higher this year, thanks to the uncertainty created by trade policy. However, so far, the evidence doesn't really support this conclusion. Indicators that track the level of uncertainty around global trade policy did rise during President Trump's first term, specifically around the period of escalating tariffs on China. And while this was associated with the stronger dollar, it did not lead to rising levels of FX volatility. We can see again at the start of Trump's second term that rising uncertainty over trade policy has been consistent with a stronger US dollar. And while FX volatility has increased a bit, so far the impact has been relatively muted, and implied volatility is still well below the highs that we've seen in the past 10 years. FX volatility is likely to rise around key dates and periods of escalation, and while structurally higher levels of FX volatility could still occur, the odds of that happening would increase if tariffs resulted in more substantial macroeconomic consequences for the US economy. Thanks for listening. If you enjoy the show, leave us a review wherever you listen and share thoughts on the market with a friend or colleague today.
The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.